Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
We are diving deep today into the recent operational and financial review of a major global technology consulting firm. We're looking at their Q4 results and the full fiscal year 2025 performance.
Mm-hmm.
And it's an absolutely crucial read for anyone trying to get a handle on the current inflection point in enterprise tech.
It really is.
You have this massive organization, and they're juggling these two, incredibly challenging pressures. First, there's this sluggish macro environment. No easy tailwinds there.
Nope, not at all.
But second, at the same time, they need to make these huge, expensive, really decisive strategic shifts just to stay ahead in the age of AI, which is moving so fast.
That's the tightrope they're walking.
So we're going to unpack exactly how they managed to post surprisingly strong growth, actually taking market share while doing this whole internal operational revolution. Yeah, that juxtaposition, that's really the heart of their story this year, isn't it? When you look at the context, this isn't a company just sort of reacting to Gen AI popping up.
Right.
They've been positioning for this structural shift for years. But FY25, like you said, it really looks like the inflection point, where those multi-year, multi-billion-dollar AI investments are finally translating into real client commitments, real revenue.
Tangible results.
Exactly. The CEO, Julie Sweet, and CFO, Angie Park, they were very clear. They had a solid 7% revenue growth, booked over $80 billion. That's billion with a B in total bookings.
Wow.
And they're using that foundation to really stake their claim as leaders, driven by this focused, pretty aggressive AI strategy. So our mission today is critical. We got to look past the headlines. We need to analyze what this operational overhaul and this reinvention services thing really means. And, critically assess the guidance for fiscal year 26, especially with that plan to reinvest, $1 billion in savings.
Yeah, that's a big number to plow back in. Okay, let's start with the financials then, the scorecard. Because, given that tough environment you mentioned, getting 7% growth for the whole of FY25, that's pretty remarkable.
It really is.
That's nearly $5 billion in new revenue, right? Pushing their total to, $69.7 billion for the year?
Just shy of $70 billion. The scale is immense.
And they were keen to point out this growth was, broadly organic, spread across different markets and industries.
Yeah, they emphasized the balance, suggesting the demand wasn't just concentrated in one hot area, but fairly well distributed.
But the scale is one thing. You mentioned the bookings figure. That's the real demand signal, isn't it?
Absolutely. Over $80 billion in bookings for the year, which is, a fantastic number. And that gives them a book-to-bill ratio of 1.2.
Right. Can you just quickly remind us why that 1.2 is so important?
Sure. So a book-to-bill significantly over 1.0 means they're signing up new work, new contracts, much faster than they're actually delivering the work and recognizing the revenue from existing contracts.
Got it. Building the backlog.
Exactly. It basically locks in future revenue, gives them visibility for the next, couple of years, which is incredibly valuable when the economic climate is uncertain.
And that leads right into their big claim about market share. They said they took market share at more than 5 times the rate of their investable basket. That sounds punchy.
It's very punchy. It's a statement of really aggressive competitive wins. Now, they define that basket as their 24 closest global public competitors.
Okay.
We don't have the super granular math behind that 5x number, obviously. But the claim itself implies they're winning the big, complex transformation deals, the ones maybe other competitors can't handle globally.
So it suggests their model combining consulting, tech, operations is working. It's sticky.
It seems so. It suggests clients might be consolidating their spending, choosing the partner who can manage the full complexity of this AI-driven change end to end.
Okay, and that strong top-line performance, it flows down, right? Cash flow looked really strong.
Extremely strong. Free cash flow of $10.9 billion for FY25. That's up 26% year over year. Just a huge amount of cash being generated.
And there was that related metric, the cash flow to net income ratio.
Yeah, 1.4. That's a sign of really high financial quality. It means their reported profit, their net income, is backed up by even stronger actual cash coming in the door.
And that cash gives them options.
Tons of options. It's the bedrock. It lets them fund those huge internal AI investments, make big acquisitions, and return a lot of cash to shareholders, all without straining the balance sheet.
Speaking of shareholders, they returned $8.3 billion in cash during the year. up 7%.
That's right. Shows confidence, doesn't it? Confidence in future cash generation, commitment to capital returns, even while they're investing heavily back into the business. It's a tricky balance, but they seem to be managing it.
Now let's pivot a bit. What's actually driving these numbers? Their ecosystem strategy seems key. They always talk about being the #1 partner for tech platforms.
They do, and the numbers back it up. 60%. 60 of their revenue comes from work involving their top 10 ecosystem partners.
And that partner-driven part grew even faster than the overall company,
Yeah.
9% versus 7%.
Exactly. That's fascinating. It's more than just, reselling software. It signals they are deeply embedded in how the biggest tech platforms, hyperscalers, ERP giants, security firms actually sell and deliver their stuff.
So as those platforms roll out new AI features,
They need Accenture to implement it, integrate it, manage it globally. The fact that this partner revenue is growing faster shows the tech ecosystem is becoming even more reliant on their implementation muscle as AI takes off.
and you see that deepening relationship with clients too, right? And the client stats. Record number of huge deals.
Yeah, a record 129 quarterly bookings over $100 million each for the year.
Oh.
And they ended FY25 with 305 diamond clients. That's their term for the absolute biggest, most strategic relationships.
305 of those.
Yeah.
It's a lot of deep connections.
It gives them incredible insight, doesn't it, into what the global C-suite is prioritizing. That intelligence itself is a competitive advantage.
Okay, so quick recap on Q4, the final quarter. Revenue was $17.6 billion, up 7% in dollars, 4.5% in local currency.
Yep, and Q4 bookings also strong, $21.3 billion, up 6% in dollars. And here's a key detail in the mix.
The managed services versus consulting split.
Exactly. Managed services bookings were really strong, $12.4 billion. That gives managed services a book-to-bill of 1.4 just for the quarter.
Wow. And consulting.
Consulting bookings were $8.9 billion, book-to-bill of 1.0. Still solid, replacing work as it rolls off, but that 1.4 in managed services, it shows clients are increasingly signing up for longer-term scaled platform modernization and ongoing management.
So managed services isn't just about cost savings anymore.
It's becoming much more strategic. It's often the vehicle clients use to adopt complex tech like AI platforms faster than they could on their own.
Right, that makes sense. Which brings us neatly to the core strategy pivot, advanced AI. Let's talk about that huge $3 billion investment they announced back in FY23. Are they seeing the payoff now?
This is where that inflection point you mentioned really shows up in the numbers. Their FY25 advanced AI revenue, it tripled compared to FY24, reached $2.7 billion.
Doubled, okay.
And maybe even more telling, advanced AI bookings nearly doubled to $5.9 billion. That surge is critical. It shows, one, the market is validating their early aggressive bet, and two, they're actually capturing that spend, turning investment into client commitments and revenue.
Now, we need to unpack that term advanced AI. They were specific about it, weren't they? Gen AI, agentic AI, physical AI.
Yes, and crucially, they were specific about what isn't included in those numbers.
Right. They explicitly left out things like basic data preparedness, classical AI models, and the AI they use internally just to deliver services. Why make that distinction so sharply?
It's about isolating the new spending wave. By leaving out the foundational stuff, setting up data lakes, using older machine learning techniques, they're focusing the spotlight purely on the revenue driven by the latest tech, like LLMs and AI agents.
So it's about showing the acceleration in the cutting-edge stuff, not just lumping all AI together.
Exactly. It highlights their ability to capture truly incremental budget shifts from clients who are prioritizing these new, high-value AI capabilities. They admitted their overall data business is busy, but the spotlight is on the advanced segment's rapid growth.
And to capture that, they needed the people. They went from 40,000 AI and data pros 2 years ago to 77,000 today.
Almost double in just 2 years. That speed of scaling specialized talent is a massive competitive barrier.
It's not just hiring, though, is it? There was a huge upskilling effort, too.
Colossal. They said over 550,000 of their own people, they call them reinventors, have been trained in the fundamentals of Gen AI. That internal prep is what lets them handle the workload over 6,000 advanced AI projects in FY25 alone. They're basically industrializing the upskilling process.
Okay, let's tackle the big strategic question, the one everyone's debating. Is AI deflationary? Does it just drive down costs and eventually the price of services?
The productivity debate. It's the defining question right now. Their argument, based on seeing tech shifts like digital and cloud play out before, it's emphatic. AI is expansionary in the aggregate, not deflationary.
But how?
Yeah.
Surely clients are using it to cut costs. automating coding, streamlining
Oh,
operation.
absolutely. They acknowledge that. But their point is the savings don't just, disappear into thin air or shrink the overall IT budget. They get recycled, redeployed almost immediately.
How does that work?
So say a client saves $10 million using AI to automate some back office stuff. That $10 million doesn't vanish. It gets plowed straight back into the next big priority on the CEO's list, things they couldn't afford
Yeah,
before,
like,
like launching a new digital product, a massive cybersecurity upgrade, modernizing their entire data estate so they can actually use the next wave of AI effectively. The efficiency gains from AI basically fund the next, often more complex and expensive, wave of transformation.
so AI efficiency creates the budget for AI-driven growth and complexity.
That's the argument. They see the CEO mandate shifting. It started maybe with just productivity, the cost out focus. But they're pushing clients, successfully it seems, to focus on both growth and productivity. Using AI savings to fund AI-powered new services or customer experiences, often tapping into their creative arm, Song, to help design those.
And that must command better pricing. We heard the pure advanced AI projects are getting accretive pricing, higher than average.
Yeah, that premium suggests there's still a scarcity of the real high-end expertise and maybe proprietary tools needed to deploy these complex models quickly and effectively. But they did say the market is still lumpy,
Lumpy.
meaning it's uneven. You've got the leaders, the big companies who are moving super fast, going from proof of concept, the POC stage, straight into full production scaling. But then you have a much larger chunk of the market just starting their first POCs now. The overall trend is towards scaling, definitely, but there's a big gap between the front runners and the rest.
Okay, that lumpy market sets up our next section perfectly. Seeing this reinvention idea in practice, the big challenge they identified is that gap between mind share and actual adoption.
Exactly. Every C-suite is talking AI faster than any tech buzz in decades. But real scaled enterprise adoption outside the tech natives, it's still relatively slow.
Why the gap?
Because AI isn't just software you install, it needs that foundation. And building it is hard and expensive. Companies are stuck with fragmented processes, siloed departments, and they still need to keep doing the basics: cloud migration, ERP upgrades, security hardening. The barrier isn't the AI model itself, it's getting the enterprise ready for it.
So advanced AI becomes the catalyst that forces companies to finally tackle that large-scale transformation of their core systems. That digital core is still the main growth driver.
Precisely. AI makes modernizing the core non-negotiable,
Yeah.
and they give some really powerful examples of this in action. The Bank of England one, that's about as high stakes as it gets.
Modernizing their real-time gross settlement system, RTGS, the thing that handles all the big electronic payments in the UK.
The very system. It handles about $1 trillion in transactions every single day. Rebuilding that on a modern private cloud with full automation that requires an unbelievable level of client trust. Trust in their ability to handle systemic risk, compliance, everything.
And the scale is mind-boggling. In the first 5 months, it processed 22.5 million transactions worth $110 trillion.
Trillion. It's not just a tech upgrade. It's building the secure, modern foundation for the UK's entire future AI-driven payments infrastructure.
You see that pattern starting with the core, then expanding in other client stories too.
Definitely. They talked about a major financial services client, a decade-long relationship. Started with digital ops, cloud stuff. That led naturally to modernizing their data estate, which, again, you need for AI.
And
Now, building on that foundation, they're retiring old legacy systems, transforming core functions like HR and risk, even using AI on the trading floor. The result, the total value of the contract with that one client more than doubled in just 5 years.
wow, that's relationship compounding.
That's the key strategic prize of the AI revolution, they argue. It turns discrete projects into these massive, ongoing, whole enterprise transformation partnerships.
Okay, moving beyond the core infrastructure, I was really interested in the Ecolab example, using agentic AI for functional reinvention. This isn't just chatbots, right?
No, this is way beyond basic automation. They redesigned Ecolab's entire lead-to-cash process using 9 scaled agentic AI agents. Think of these agents as software that can perceive, decide, and act autonomously to achieve goals.
Okay, so what are these agents actually doing in the lead-to-cash process?
They're handling complex, tedious financial tasks, cleaning up core data, resolving billing mistakes automatically, matching customer payments to invoices. The specific example was cash application matching payments received to outstanding invoices. That used to be 100% manual work.
prone to errors, I imagine. And slow.
Very. Now with the agents, it's about 60% automated. That frees up the human finance team to do higher value work analysis, strategic planning, handling complex disputes instead of just data entry.
And the expected business impact for Ecolab.
Pretty significant. They're looking at 5% to 7% sales growth and hitting a 20% operating income margin, crucially, without increasing costs at the same rate. That's agentic AI directly boosting the bottom line. It supports that expansionary view.
They also showed AI transforming physical operations, didn't they? The energy company example sounded incredibly complex.
Oh, it was. Reinventing field operations in the energy sector. You've got huge scale, safety concerns, cost pressures, environmental issues. The first step was unifying data from over 25 different legacy systems into one cloud core, a massive undertaking in itself.
And once the data was unified,
Then they could build AI-powered digital twins using their own industrial intelligence suite.
digital twins, so like virtual copies of the physical assets.
Exactly. Virtual models of the wells, pipelines, equipment, all constantly updated with real-time data. This lets them monitor and optimize the entire field, often remotely. It gives them predictive capabilities, anticipating failures, optimizing production.
What are the expected results there?
Really impressive. Reducing lost production by up to 4%, boosting worker productivity by up to 28%, cutting overall costs by up to 22%, and, importantly, reducing emissions and the need for people to physically be out in potentially hazardous fields, so it hits efficiency, safety, and sustainability.
Okay, before we move off client work, we have to touch on security. It grew 16% this year. All this digital core building must make companies a bigger target.
Absolutely. Security is the non-negotiable foundation. As AI speeds everything up, it speeds up the threats too. That 16% growth shows the demand for integrated, smart security, and they've been acquiring heavily here.
Right, the big acquisitions.
CyberCX was their largest cybersecurity buy ever, added 1,400 specialists in Asia-Pacific, plus AI-powered security platforms globally. And they bought IAM Concepts, a Canadian identity security firm focusing on critical infrastructure, deepening their ability to protect access to this new AI-enabled core.
So investing heavily to protect the very transformations they're enabling. Makes sense. Okay, let's shift gears now to the internal changes. The operational shifts needed to support all this. First up, reinvention services. What is that?
It's a major internal reorganization launched September 1st. Basically, they're consolidating everything, consulting, technology, operations, even the creative song unit into one single entity.
Why the big reshuffle?
Efficiency and speed. They found that almost 80% of their big deals already involved multiple service lines working together. The old siloed structure just created friction, slowed things down. This new model aims to make it faster and simpler to sell and deliver those complex integrated solutions, and, critically, to embed AI and data more easily into everything they offer.
Okay, simplification. But then alongside that, they announced this big business optimization program with a hefty price tag. Let's dig into that $865 million charge.
Yeah, that definitely caught the eye. It's a 6-month program, started in Q4. Total expected charge around $865 million, most of it, 615M hit in Q4, the rest coming in Q1 FY26. It has 2 main parts. Part 1 is what they call rapid talent rotation, which is basically severance costs for headcount reductions, specifically in areas where they decided reskilling people wasn't really feasible for the skills needed now in the AI age.
So letting people go whose skills aren't aligned anymore.
Essentially, yes. The second part was divesting 2 acquisitions that they felt no longer fit their kind of accelerated strategic priorities.
That rapid talent rotation. It sounds pretty aggressive.
Yeah.
Is there a risk, for morale, for the hundreds of thousands of reinventors still there?
It's a fair question. The execution risk is definitely there. But their justification comes back to the sheer speed of tech change. They're arguing that some skills, particularly in older IT areas or non-AI back office roles, are just becoming obsolete so quickly that they have to act fast to keep their workforce aligned with what clients are demanding.
And the money saved isn't just pocketed.
That's the crucial point. The stated goal is that the savings from this program, expected to be over $1 billion, will be fully reinvested back into the business, back into the people, funding that massive upskilling effort we talked about, funding new acquisitions, funding internal AI projects to make Accenture itself run better.
So take the hit now. Use the savings to accelerate the shift to AI-ready talent.
That seems to be the strategic calculation. It's the third part of their refreshed talent strategy. 1, massive upskilling. 2, targeted exits where upskilling isn't viable. And 3, continuous internal efficiency drives using their own AI.
And despite these cuts, they still expect overall headcount to grow next year.
Yes, they were clear on that. They expect headcount to increase overall across all three markets, US and Europe included in FY26, which signals just how strong they believe the underlying demand for the right skills still is.
Okay, one last internal detail that seemed a bit odd. Capital expenditure, CapEx. It's going up significantly in FY26 by $400 million to $1 billion total. But if everything's moving to the cloud, why spend more on, well, on what?
It's fascinating, isn't it? It's counterintuitive. The main driver for that increase is good old-fashioned real estate.
Buildings.
Buildings, expanding office space, improving existing leases in certain key locations. It reflects a strategic decision, they said, to bring more people back into the office.
In an age of remote work, spending an extra $400 million on offices. Why?
Their rationale is that the really complex, high-trust transformation work, think Bank of England, think deploying sophisticated agentic AI needs intense collaboration.
Wow.
Sometimes that means being physically together. It's also about security for sensitive projects and maybe integrating acquisitions more smoothly. It signals they still see significant value in physical proximity for their highest value, most complex work.
Interesting. Okay, so we've covered the performance, the AI strategy, the internal shifts. Let's look ahead now. The FY26 outlook. They started by saying the overall market backdrop hasn't really changed much.
Yeah, no major positive or negative shifts seen, which lets them frame their guidance quite pragmatically. They're basically modeling two scenarios for discretionary spending by clients. The top end of their guidance assumes things stay about the same. No big change in clients' willingness to spend on discretionary projects. But the bottom end prudently allows for things to get worse, for that discretionary spend to pull back. They're focusing on being relevant no matter what, banking on the idea that AI transformation isn't really discretionary anymore for many clients.
Right. So what is that FY26 revenue guidance number?
They're guiding to total revenue growth between 2% and 5% in local currency. But, and this is a key, but their federal business, AFS, is expected to be a significant drag.
How much of a drag?
They expect it to contract in the mid-teens percentage-wise in Q1 and likely pull down the overall company growth rate by maybe 1% to 1.5% for the full year. Seems mostly related to government budget cycles, maybe some post-election uncertainty freezing things up.
So if you strip out that federal piece, what's the core business expected to do?
Excluding AFS, they expect the rest of the business to grow between 3% and 6%. And that guidance includes their plan to keep acquiring companies. They're earmarking another $3 billion for acquisitions in FY26.
Same amount as the initial Gen AI investment.
Exactly. And they expect those acquisitions to contribute about 1.5% to that overall growth number. So still very much using M&A to buy strategic capabilities.
And how does that 3-6% core growth break down between consulting and managed services next year?
They expect both segments to be pretty balanced, landing in the low to mid-single-digit growth range. But they stressed again how managed services is evolving. It's not just about cost anymore.
Right, becoming more strategic.
Yeah, driven by clients needing to adopt advanced tech like AI platforms and the operations around them faster than they can possibly build it themselves. They need Accenture to bring the scaled platforms and the trained people right now. So managed services is a key growth engine for strategic tech adoption.
Okay, what about profitability? Margin guidance, earnings.
Adjusted operating margin is guided to 15.7% to 15.9%. That's a slight expansion, maybe 10 to 30 basis points over the adjusted FY25 number, which, considering they're reinvesting that $1 billion in savings, is actually quite strong. Shows they expect operational leverage even with heavy investment.
And EPS.
Adjusted diluted EPS expected between $13.52 and $13.90. That's solid growth, 5% to 8% over the adjusted FY25 figure.
And based on cash flow expectations, shareholder returns stay strong too.
Absolutely. Free cash flow expected to be robust again, $9.8 billion to $10.5 billion. And based on that, they're committing to return at least $9.3 billion to shareholders in FY26. That's a 12% jump from FY25.
And they back that up.
Yep. The board announced a 10% dividend hike to $1.63 per share, and they approved another $5 billion for share buybacks, signaling confidence, stability, and future growth.
Okay, just wrapping up the outlook. Any interesting comments on external stuff? Policy, regulation, H-1B visas came up.
Yeah, on H-1B visas, they basically said it's a non-issue for them. Only about 5% of their U.S. people are on H-1Bs, mainly for very specialized roles. So changes there don't really disrupt their model.
Broader policy shifts like healthcare rules, tariffs.
They almost welcome that kind of complexity. They see change itself as a growth driver. Their whole business is helping clients navigate new rules, compliance changes, shifting political agendas. Regulatory headaches for clients often translate into transformation work for them.
Okay, so let's try and synthesize all of this. What's the big takeaway from this whole review?
I think the crucial finding is that this shift to the age of AI, it's not theoretical anymore. It's actively restructuring the enterprise right now. It's driving these huge, complex transformations, leading to bigger client relationships, bigger contract values.
And internally, they're matching that external shift.
Yes, through that strategic talent rotation, making tough calls via the optimization program and pouring money into upskilling and internal efficiency. They're acting decisively to align their workforce and operations with this massive demand wave for advanced AI skills.
So the core strategic insight seems to be their conviction that AI is expansionary, that savings get reinvested, driving further transformation.
Exactly. Which leads to, I think, a really provocative question for you, the listener, and for every organization out there. Given how fast this tech is moving faster than previous shifts, how quickly do you need to pivot your own growth strategy? How fast do you need to reinvest any savings to grab that AI value before your competitors do?
Before they free up their budget and beat you to the punch on the next big priority.
Precisely. The window for just getting your basic AI foundations ready feels like it might be closing. The next phase looks like it's all about aggressive, sustained scaling.
A compelling thought to end on. Thank you so much for tuning in to the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.